What happens to taxes after Chapter 7 discharge? Have you ever wondered what happens to your taxes after you go through Chapter 7 bankruptcy? This is a common question, and understanding the details can make a big difference in your financial future. When someone files for Chapter 7 bankruptcy and receives a discharge, they are generally released from personal liability for most debts. This includes certain tax debts, which means you are no longer legally required to pay those discharged debts. Creditors, including tax authorities, cannot pursue collection actions against you for those debts. However, it is important to note that not all tax debts are dischargeable in Chapter 7 bankruptcy. For income tax debts to be discharged, they must meet specific criteria. First, the tax debt must be for income taxes, not for other types of taxes like payroll or property taxes. Additionally, the tax return for the debt must have been filed at least 2 years before you file for bankruptcy. Another requirement is that the tax debt must be for taxes assessed by the Internal Revenue Service at least 240 days before the bankruptcy filing. You also must not have committed fraud or willful tax evasion related to the tax debt. Lastly, the tax returns must have been filed on time or at least 2 years before filing for bankruptcy. If you meet these conditions, Chapter 7 bankruptcy can wipe out your personal obligation to pay those income tax debts. This effectively discharges them, preventing the Internal Revenue Service or state tax authorities from collecting those discharged taxes after bankruptcy. On the flip side, certain tax debts are not dischargeable in Chapter 7 bankruptcy. These include taxes related to fraud or willful evasion, payroll taxes, or trust fund taxes. Recent tax debts assessed within 240 days before filing are also not dischargeable. If you did not file your tax return or filed it late within the required timeframe, those debts remain your responsibility. Even after receiving a discharge, you must still comply with federal income tax laws. This means you need to continue filing tax returns and paying any non-dischargeable taxes or future tax liabilities. The discharge only eliminates your personal liability for qualifying past tax debts. It does not erase the tax itself or the requirement to file returns. In summary, after a Chapter 7 discharge, qualifying income tax debts are wiped out, releasing you from personal responsibility to pay them. Non-dischargeable tax debts remain your responsibility. The Internal Revenue Service and other tax authorities cannot take collection actions on discharged tax debts. You must continue to comply with tax filing and payment obligations for non-dischargeable or future taxes. Understanding these details can provide significant financial relief, but it is wise to consult with a bankruptcy attorney to evaluate your specific tax situation before filing for Chapter 7 bankruptcy.